looks like we're live, and welcome to the fourth episode of Monetary Forces, in which Izabella, Kaminska, and myself combine our big picture perspective with the details that we love to bring you insight you're not going to get elsewhere. Insight into what? Both Izabella and I focus on the intersection of new technologies and monetary forces, and we look at how together they are changing the global financial landscape. We both come at it from different angles. Izabella, as I'm sure you know, is a household name in terms of monetary plumbing expertise, and her background in traditional finance totally, she knows, she's forgotten more than I will ever know. And she's the author of two newsletters, The Blind Spot and The Peg, strong recommends. I write the Crypto is Macro Now newsletter. And so I come at this fascinating intersection from the world of crypto, traditional finance, fund management, geopolitics, and macro. And I think Izabella will agree with me, it's just getting more and more interesting every single day. Now, next week will be our last one before we take before we indulge in the sacred European tradition of a summer break. But, watch this space for updates on when we're back. And, like last time, we'll start off with a brief comment on three headlines, news items that caught our attention over the past few days that highlight the massive changes that we're seeing in the world of money. Full stop. And then one of us will dive deeper into a paper we read, going where AI summaries don't, and filling out some of the overlooked context of the serious intellectual work, the firepower that is going into understanding the changes we're living. This week it is my turn, and I'm going to look at how stablecoins influence the money supply. It's not what most of us have thought. We've always assumed stablecoins don't affect deposits. They really do, and I'll explain why. Izabella, have I forgotten anything?
No, not at all. And thank you for doing the heavy lifting this week, Noelle, because I've been feeling a little bit under the weather. So I'm here mostly as a sort of sounding board today. But well, let's crack on with our three news items. To begin with, I believe, Noelle, you've been looking at this Sony story.
I have. Before going to, actually, I'll start with Sony. I was going to start with Swift because that's another one.
Oh, sorry. Yes, of course.
I think Isabella's right. I'll start with Sony because she and I were chatting beforehand, and I was saying that this is a seriously overlooked impact, and I'm still trying to figure out why it hasn't been getting more coverage. Oh, I do have to explain to everyone before I proceed, I have a new computer, and I accept your condolences. You all know how stressful that is, and one of mine is that this camera is different. So if I look a bit fuzzy, it's not because I'm feeling fuzzy, although with the Spanish heat, you'll understand. Also, there's the getting ready for the game tonight. But if so, I will have a new camera hopefully by next week. Now, diving into Sony. Last week, Sony got conditional approval from the Office of the Comptroller of the Currency, the OCC, for a national trust bank in the US for the express purpose of issuing and managing a dollar stablecoin. Target launch in 2027. Now, this is not just another stablecoin story, not at all. It goes much deeper, and there are three levels that I think are being overlooked. One, Sony continues to expand our understanding of stablecoin business models. Now, here we have a consumer-facing company issuing its own stablecoin via financial subsidiary. And obviously, one effective use case could be internal treasury transfers with obvious advantages for the sprawling multinational with plenty of cross-border transactions, both between and within departments. I mean, Sony is big, so they could save a lot of money there. Sony also, though, and this is where it gets really interesting, Sony has a seriously vast community. PlayStation alone has roughly, let me check the number here, 132 million monthly active users. That's just PlayStation. And then there's the movies, the streaming services, the music labels, all of which involve or can involve digital transactions of some kind. Oh, and Sony has a fully licensed consumer-facing online bank in Japan. So you can sort of see where I'm heading with this. Now, it's no surprise that Sony has been active in blockchain experimentation for years. It has been involved in tokenization, NFT issuance, its metaverse experiences, it's launched apps and more. I'm not even scratching the surface there. But introducing a stablecoin into both its on-chain and off-chain worlds, we can start to imagine how these different properties can overlap, and also how Sony can reach a new level of engagement with its vast community network. I'm imagining things like DeFi applications in the metaverse. If you want to swap your sword for a shield, well, you can do that on a pool, for instance. I mean, that kind of thing is something that we've seen some experiment with, but no one at the scale and depth of Sony. It's absolutely fascinating. Now, Sony hasn't specified what blockchain they're going to use, but here's a twist. Sony has its own blockchain that it launched last year. It was co-developed with Startail Group, which is a web infrastructure, a Web3 infrastructure developer. So is it going to use Soneum? Probably, because there are strategic synergies there. Soneum has a stablecoin already, but it's tiny, and that was issued under the Singapore regime. This is going to be issued in the US, and the US market is huge. So Sony stablecoin is not just about transfers or payments. It's about a whole new type of consumer business model, and I think that's fascinating. Before I get on to points 2 and 3, Izabella, any questions on that one? Anything you want to add?
No, I mean, I think it's just fascinating, as you say, that these large conglomerates, I mean, can we call Sony a conglomerate? Not quite, but almost, are really trailblazing in this domain. And it'll be interesting to see who replicates or emulates that move, because I'm sure Sony won't be the first and only.
Yeah, absolutely. But there's a twist, and it's about regulation, about banking regulation. The second level of my fascination with this is to do with what it teaches us about US banking regulation. And here's where Sony, and funnily enough, strangely enough, has a clear advantage. Now, there are two things. First of all, when Sony's subsidiary, Connectia Trust, US subsidiary, filed its application last October, there was a strongly worded objection from the Independent Community Bankers of America lobby. Now, they're generally objecting to anything to do with stablecoins, so no surprise there. But they pointed out that the National Trust Charter that Connectia, Sony, has gotten conditional approval for is not supposed to be a retail-facing institution. And this is true. National trusts don't deal directly with retail. That's just not how. But the Genius Act does allow national trusts to issue retail-facing stablecoins. So that's an interesting twist on the banking regulation there. But the other is even more interesting. Now, get this. Sony is entertainment company, whatever you want to call it. It has financial subsidiaries. In the US, that's illegal. In Japan, it's not. So Sony arguably will very much benefit from the issuance of a US stablecoin under US regulation, with presumably the benefits flowing to head office in Japan. Disney, to pick a competitor, can't do that because Disney, according to US law, cannot own a financial subsidiary.
That is a really good point, Noelle, which I hadn't appreciated. But the asymmetry there definitely gives all kind of. I mean, it's not just going to be Japan. Presumably, there are other. I don't know if you know. Like, are there any other jurisdictions which can do that sort of thing, or is Japan quite unique in that?
No, I would imagine most can. I would say it's the US that's unique on this. I'm not a lawyer, obviously, nor am I a legal expert in banking around the world. But the US has the largest banking industry. And it has had cases in the past, and that's why this law was passed, where you have consumer giants, in a way, sort of minting their own money via their banks. And that obviously raised some concerns. It could also enhance the fragility of the system. And the US obviously doesn't, they can't allow that kind of fragility, which is why this law was passed. But here we have Sony benefiting from that law, whereas US-based competitors can't.
And under the framework is the idea then that where is the predominant sort of market for this stablecoin? Is it going to be in the US?
Yes, it'll be in the US. That's what they have said, right? US facing for the US market, but it's a stable coin. It can go where it wants. And while the US is, I don't know if it's Sony's largest market, I have to confess. I know that the gaming community and Sony deep in the Japanese entertainment networks as well. So I don't know if it's the majority or just a very big chunk. But again, these are stable coins and they will cross borders because that's what stable coins do, which highlights the choice of blockchain. I mean, Soneum is relatively limited at the moment. It's L2 on Ethereum, I believe, but it's not Ethereum. It doesn't have the open network some of the other L2s do. I wouldn't be surprised maybe to see Soneum being used for metaverse experiences or in-game applications, and maybe the stablecoin will be available on some of the other chains as well, as many of the other issuers have chosen to do.
So my only other thought, and I haven't really thought about this very intensively, is it's very interesting in the context of where the Japanese economy is right now, in terms of what's happening to dollar yen and Japanese inflation and obviously interest rates and yields. I think it's really interesting generally that Japan has jumped on the yen-denominated stablecoin bandwagon last year. I think it's sort of accelerating its own ambitions there, which could or could not. I mean, it could theoretically be useful in terms of creating demand for its own JGBs, but the other element in the cross border the cross border dimension of this is, as interest rates go up in Japan and the yen market stop being a natural and cheap funding source for international capital markets, I wonder if this will allow Japanese firms to basically leverage, cheaper deposits in the US or get access to dollar funding this time around, rather than the other way around. So you have this. I don't think we're there yet, but there is an interesting sort of dimension that they might be sort of looking ahead, and it's also worthwhile remembering that the Japanese experience with financialized corporates in general and the degree of mess that got them in back in like the noughties, I think it was. Is this going to be the second coming of, I think they called it Zytec back then, which was the corporates that stopped doing their underlying business and started just financializing themselves because the gains from financialization were just much greater than from their underlying business. And again, I haven't thought about this very intensely, so these are just like random, might be no connection whatsoever.
No, it is relevant, and it's the perfect segue. Thank you. We didn't coordinate this before. It's the perfect segue to the third level of fascination with this, and this is the distinct environments that we're looking at here. You were talking about a time in Japan that feels long gone. Japan had the excess, paid the price, and has since then been as conservative as you can possibly get. Now, this is interesting because Sony is a Japanese corporation and its home jurisdiction was the first main economy to pass stablecoin law. This was back in 2022, easily the first, well ahead of the pack, went live in 2023. Today, the middle of 2026, the authorities have authorized two stablecoins, only one of which is issued by a trust, that's SBI, which is a big financial conglomerate. So they're being really, really careful. And this is a sort of reminder that jurisdictional styles matter. Sony has experimented with stablecoin issuance in Japan in the past with yen-backed stablecoins on Polygon, if I remember correctly. But no, its big stablecoin launch, its flagship stablecoin, it's choosing the United States to do so, not just because of the Genius Act, in my opinion, but because of the innovation forward approach of US regulation, something Japan today does not have. You're right, that might be changing, the political environment is different than, say, 2 years ago now. And there is a lot of talk about we need to modernize finance. In fact, this week, Tokyo is hosting Asia's largest blockchain conference of the year. It's the world's largest of the year, and it's in Tokyo this week. And it was opened by a keynote by Japan's prime minister. Japan's finance minister gave the closing keynote on Monday. Japan's minister for culture, for digital affairs. It's full of officials giving keynotes at a blockchain conference hosted by a crypto media site, which I think is a sign. Now, this isn't new. The prime minister has given, different prime ministers given keynotes at blockchain conferences in Japan before. At the time, I thought this was astonishing. This was when the United States was, crypto was poison. But nothing much happened because of it. So again, I'm not sure if this is just being there for the photo and trying to look like you support innovation. The United States has shown that it actually does. And I think that is a bigger picture here. Jurisdiction matters, not just because of the legal framework, but because of the support for innovation.
Absolutely. So now I guess it's time to move to point 2.
Yeah, let's move to Swift, and we'll be brief here because there's a lot to get to today. Now, Swift has launched a blockchain platform. It went live last week with 17 major banks from 6 continents using the platform for pilot cross-border transfers of, not stablecoins, deposit tokens. And this wasn't a surprise. It was announced at last year's Sibos. In March, we found out that the design had been completed. But now it is live in a limited format, but still. And this is Swift. Swift, as I'm sure most of you know, is responsible for handling pretty much all of the messaging between banks. In other words, cross-border payments could not happen today without Swift. And Swift, to its credit, saw the disintermediation potential from on-chain networks. When the message is the transfer, as in public networks, then what is Swift's role? But we've spoken often on this podcast before, Izabella, haven't we, about how deposit tokens have a limitation, and that is their network size, which affects their liquidity. They are tokens issued by banks backed by client deposits, which means they can't exit the bank network without converting into a stablecoin or into another deposit token. In other words, they're not fungible. That impacts their liquidity. Last week, you were talking about a type of unified ledger for deposit tokens that would give them some of that liquidity. We've seen other consortia try to do something similar, but this is Swift. Now, even unified ledgers and consortia are going to have some walls. They're going to have limitations. This is Swift, which works with over 11,500 banks already. And it wants to continue to be the connector. It's not going to handle funds. It's not, I assume not, there's no reason why it would. It's going to orchestrate, it's calling itself the orchestration platform. It's going to orchestrate deposit token transfers between participating banks.
Yeah, I mean, this is a big deal. I mean, obviously it's Swift has been kind of in defensive mode ever since the BRICS countries. China has been trying to outmaneuver them with their own CIPS network coming in. Do you think, though, this is going to be too little too late, or do you think there's actually going to be some improved functionality here that will allow them to somehow protect market share?
I think it's going to be a big deal. I mean, time will tell, obviously, but this is Swift. It has the relationships, the consortia that we've discussed, the unified ledgers that we've talked about. They will require onboarding, which requires a lot of marketing to start with, a lot of back-end hassle. Swift has the relationships. Swift is a trusted name. Swift already works with global banks. The threat is, you're quite right, networks that don't touch Swift. And they will continue to be a threat because I don't think anyone's going to forget the events over the past decade. But this is a way for Swift to retain its relevance in an increasingly on-chain world. And it is, I would argue, better positioned to do so than many of the consortia, which themselves might be connecting into Swift. It will bring liquidity to the network. We haven't seen a white paper yet. As far as I know, one has not been issued, and I have looked. So I'm not quite sure how the orchestration will actually work. And always when there's a conversion, there is risk. The interoperability is just riddled with risk. But again, this is Swift, and we can assume it's being careful. I'm not a Swift fangirl or anything. I think there's a lot that they could have done better over the years, but they do have the clout, they have the budget, and they have the expertise in-house. And if not, they know how to get it.
Yes, absolutely. So I guess quickly to point 3, because we are actually a little bit over time. I'm not going to dwell a lot on this because this really merits its own sort of deep interest, deep analysis and review in terms of one of the papers that we properly look at. But I thought it was worth flagging. There's this new paper by it's a trio of economists: Stephen Miran, Noelle Roubini, and Mr. Ireland. I've forgotten his phone.
I think.
I've got to, as usual, I have too many tabs open, and I've managed. Here it is. Sorry, I always get lost in my tabs. So yes, it's from Hudson Bay Capital. Roubini and Miran are sort of, I think, senior strategists there in some sort of advisory capacity. Peter Island. All of them, incredibly experienced. And the paper is about monetarism, a return to monetarism, no less. Stephen Miran tweeted about it today. I've had a quick look at it. I haven't gone. I think Noelle's actually done more reading than me in terms of the intensity, but it is interesting. So basically, it highlights that monetarism has been unloved for a while at the Fed. It really speaks to like what era you come into finance in, because when I came to the FT, in fact, when I was at CC, so noughties, early after post-crisis GFC, this was very much the tail end of the monetarist era, I would say, and everyone I spoke to kind of had a sort of very monetarist mentality. I think that was still very dominant. Post 2008, I think Keynesianism really came to the fore. I'll never forget in 2008 when there was this funny video that went round and went viral. It was like a rap between Hayek and Keynes. And it wasn't quite, monetarism versus Keynesianism because it was Hayek, but it was nonetheless, like, I think symptomatic of what was going on in that era, which was this fight between two different schools. And Friedman was very much on his way out. And this speaks to exactly that trend. So the paper first sort of focuses on the history of monetarism. I mean, most of our readers will be very familiar with that, but it notes how, to what degree the Fed has just basically decided post sort of 2008 that these figures, these monetary aggregates that it's been looking at for a while, are just not that useful. And an anecdote I will share is that I remember when M3 was discontinued. That happened in 2005. So at the time, the Fed was putting out a lot of data on all these different aggregates. And it was quite a conspiracy theory that, like, why had the Fed stopped tracking M3? Because, and the gold bug blogs, they were all over it. They thought it was indicative of some sort of huge incoming crisis. Now, of course, as it turns out, they weren't wrong because they discontinued it in 2005. And what happened in 2008? That said, and not like in 2008, I actually wrote a little piece about the missing M3 based on a paper from, I think, Morgan Stanley, who had made that exact connection. So I'm very glad that finally, however many years later, there is a sort of acknowledgement that maybe these aggregates could have had more of an, could have played more of an important role than they did in that key period between 2005 and 2008. Of course, one of the reasons they didn't, and one of the reasons against using them, is that they were sometimes misleading and they weren't necessarily as indicative of inflationary pressures as people, as sort of the monetarists had maintained. So this paper is very much about how Kevin Walsh, when he takes, when he was already at the Fed, but when his sort of style of monetary, like, he studied under Friedman himself, so he's positioned as a sort of Friedmanite to a certain degree and a monetarist, albeit not a radical monetarist, I think a sort of moderated monetarist. But when his regime really comes into comes into play, to what degree will this monetary mindset change the way the Fed operates? And I think the main contribution, I'll be interested to see if Noelle agrees with me, of this paper is that when we look at these monetary figures, we actually have to be a bit more. We have to be a bit more discerning. We have to. It's no good just taking broad measures because, which is what the Fed used to do when it tracked these numbers. You need to discern between the liquidity elements of all the different measures and actually quantify them in some ways and weight them accordingly. And that process was developed by somebody called Divisia, who I'd never heard of, embarrassingly. And so the paper very much sort of recommends that if we do start, we shouldn't necessarily target like these new like monetary aggregate goals, but we should use them to inform monetary policy. And when we do, we shouldn't just do it bluntly. We should adjust data to ensure it accounts for the different types of moneyness in the different in the different measures, i.e. T-bills have an element of moneyness to them, but it's not quite the same as deposits or checking accounts, etc. And you have to fine-tune those measures accordingly. And then when you do that, it turns out actually maybe those measures are very insightful in terms of where the inflation is coming from and to what degree the Fed has to adjust the monetary picture to so it's not just pure interest rate, administrative interest rate sort of targeting. And then there's another element in the paper which just talks about the kind of shift towards administrative rates in general. But I think that's for another time. But Noelle, what do you think?
One of my favorite parts of the paper was there's obviously not a lot of love lost between Miran and Powell, and the authors specifically say somewhere buried in the paper that had the Fed been looking at monetary aggregates in 2021, they would have been able to get ahead of the inflationary surge. But they chose not to, for reasons best known to themselves. To be fair, Miran does a good job.
Well, for reasons, like the gold bugs would definitely have a good idea for what reasons. I mean, they were convinced.
Yeah, exactly. But the reason gets in the why did they not think of looking at monetary aggregates? And the reason, he explains why they didn't, and it's not unreasonable. And that is they just stopped working because round about the time of the financial crisis, starting beforehand, you started to get the rise of shadow banking, new types of payments, new types of money, and the monetary aggregates, which basically just added up the different categories, weren't able to take that into account. They weren't able to reflect the shift in consumer habits and therefore also the monetary supply pressures that were building, which is why they suggest, as you mentioned, the Divisia aggregate, which got me really excited. It's hard. I've never actually thought, oh, wow, when reading about monetary aggregates before. This is the first. But I read this and I thought, oh, wow. And the reason is, as you said, Divisia suggests taking the distinct monetary types. You've got your M0, M1, and 2, but then applying a weighting to them according to their moneyness, according to how much they behave like money, liquidity, and things like that. And you have your central bank currency, which is pure money, that would have maximum weighting. You've got commercial bank money, which would have a high weighting, but less so. You've got treasury bills, which they would include. Treasury bills, money market funds, they have money-like characteristics, but they would have a relatively low weighting. And this isn't mentioned in the paper. This is my addition here. The oh wow moment came from obviously stablecoins are going to go in there at a weighting between treasury bills and commercial bank money. And this is a way to bring stablecoin calculations into not just the money supply aggregates, but also monetary policy, which is a perfect segue into the paper.
Oh, your paper. Yeah, absolutely. So go on, explain to the readers what you've been looking at in very much detail.
Okay, I'm going to be brief though, but it's not going to take very long because
it's a short paper anyway.
Yeah, it's a short paper. I won't lie. Yeah, it is a short paper. I won't lie. It took me a long time to actually grok all of the charts that they had in there because I don't have Izabella's expertise on monetary plumbing. So her input in this is going to be interesting. But it is again one of these oh wow moments, and it okay. First of all, what is the paper? It's called. The title is, get this, Stablecoins and the Exorbitant Privilege of Money Creation. And it highlights how stablecoins create money, and stablecoin issuers do have the same exorbitant privilege that banks do. This is contrary to common perception, which is what really got my attention. Now, this paper was published earlier this year, I think it was in February, by the European think tank, the Center for Economic Policy Research, known as CEPR, and it was co-authored by Claudio Borio, who is what used to be head of monetary and economic department at the Bank of International Settlements. In other words, he knows his banking plumbing for sure. Now, here's the main takeaway. The paper shows that stablecoins have the power to muscle into the creation of new money well beyond simple stablecoin issuance. And I'm surprised this hasn't received, I'll get into how in a second, but first, here's why it made me sit up. I'm surprised it hasn't received more attention. We know the banks are up in arms about whether stablecoins are going to, decrease the supply of deposits, and because maybe they'll earn yield and that'll cause a bank run. They're fighting in totally the wrong arena, and I don't know why. It's really odd. Meanwhile, it's likely that the Treasury is aware of this money creation mechanism and sees the growth of stablecoins as an opportunity to not only generate more demand for treasuries, for sure, but also to surreptitiously perhaps wrest power away from the banking industry. I mean, it's not a coincidence that Warsh and Besant are friends. Anyway, that's a different conversation we'll have another day. But I'm going to briefly go over the paper's argument, and then I'll point out another money creation vector that I think the paper overlooked. And Izabella, I'll pause sort of halfway through and see, jump in. Okay? So first of all, Money Creation 101, brief synopsis. Banks create money by lending. They just magic up new money and drop it into your account. But that's true, but it's not the full story. It's more accurate to say that banks create money by creating a deposit. They magic up a certain amount and they put it into an account. And that can be for a loan, or it can be to buy an asset. If the bank wants to buy a government bond, for instance, it will just magic up $100 million and deposit it into the dealer's account. They gets the bond, the dealer is $100 million better off. Well, not better off because of the asset switch, but there's $100 million more money in the system. That is basic money creation right there. A shift from deposits to stablecoins does not reduce deposits, as the banking lobbies argue. It reshuffles them. But there's a definitional parenthesis that they're all overlooking. And that is deposits to the issuer of a payment mechanism don't count as deposits. And this is something that I confess I didn't even know. But here's how it works. Stablecoin purchaser buys 100 million or sends $100 million to a stablecoin issuer to buy stablecoins. Now, that $100 million deposit passes from the stablecoin purchaser's account to the issuer's account, and the purchaser gets 100 million in stablecoins. Now, the money supply has not increased because the $100 million deposit at the issuer doesn't count as deposits anymore. It doesn't count as part of the money supply anymore. But if the stablecoin issuer then wants to use that 100 million to buy reserves, such as a treasury, it will send that 100 million to the dealer, then it re-enters circulation. That 100 million now re-enters circulation, so it gets added back onto the money supply. The purchaser has 100 million stablecoins. The dealer has 100 million in what was the stablecoin purchaser's deposit, and there's 100 million more money in the system. It's complicated, which is why I'm sure you can understand why I spent a lot of the weekend just staring at these charts and turning them upside down even a few times didn't really help. But it is that parenthesis. If the stablecoin issuer holds on to the 100 million, no new money. If it passes it on to a dealer or a seller of a money market fund or whatever, it re-enters circulation. That is new money.
I mean, just to jump in very quickly, I mean, the authors are, incredibly credentialed and experienced central bankers like Borio. I totally trust them, but it's fascinating to me how they've come to this conclusion when, more broadly, most economists that I speak to think that there isn't a net creation with stablecoins. In fact, when I interviewed Stephen Miran in February this year, he himself said that he described them as a wrapper, and he didn't think that they would have too much impact on monetary policy or transmission as a result. So that sort of discrepancy itself, I think, is fascinating.
It gets more fascinating even still. I will just throw out there the possibility that they don't want us to know this, because can you imagine the banking industry protests? I don't understand why the banking industry hasn't thought this through yet. But
I'm sure they have. I'm sure that's part of the reason they're so up in arms about clarity and all that.
Yeah, they were noticed a bit too late, because even if clarity doesn't pass, Genius holds, and Genius allows this. Now, Genius allows a lot of other things we're not really fully aware of either, which amp up the money creation potential and even could make stablecoin issuers partial to the exorbitant privilege that banks have. In other words, right now, the money creation that I've mentioned about involves passing on a deposit it received. That's pretty straightforward. But now let's think this through. The dealer that has this new 100 million deposit then uses that to buy new government debt. This is new government debt. It's not buying from the secondary market. It's going directly to the issuance. Right? And then the government now has 100 million of that money. Now, let's say the government then puts that back into the economy. That enters deposits. Another 100 million has entered circulation. That's amping up the money creation. And it gets even crazier when you start to realize we don't even have to just limit ourselves to deposits here. But I'll progress, because there are two things that I want to talk about here, and then I'm going to go into two things I think the paper overlooked. One is that stablecoin issuers can hold their deposits at the central bank, and this is a proposal that we've talked about on this podcast before. But if it does that, then that is shrinking the money supply, because money at the central bank is not counted as a deposit in the banking system. It's like currency. It leaves the banking system, and that shrinks the banking supply. Now, if the central bank found itself with too much reserves, it could go to the market and buy assets from dealers, QE, or not QE, whatever you want to call it. But here we are glimpsing how stablecoins could become a tool for monetary policy, which is fascinating. And then the second thing that is worth pulling on here is that if stablecoins become widely used for settlement, a stablecoin issuer could bypass the deposit transfers and directly issue stablecoins to buy treasuries. It doesn't need to pass to the dealer or anything like that. It can just directly go to the treasury market itself with the deposit. And this is kind of like the exorbitant privilege of banks, because there's nothing ingenious to stop a stablecoin issuer, much like the banks can do, of printing the stablecoins, minting the stablecoins, and then buying the treasury. It's made up the stablecoin. It's magicked the stablecoins into existence, and it's bought the necessary reserves. It is complying with the Genius Act.
That's so interesting, because in that scenario, the stablecoins sit on the balance sheet of the issuer, waiting to be sort of put into circulation. So that I think they already do this a little bit, because they want to ensure smooth creations and redemptions, and sometimes there's a need to hold a bit of balance sheet to kind of regulate the peg and make sure it's so that there's you can kind of drip stable coins into circulation as and when. But that's really interesting, because
it's not much of an issue today, because for now the government doesn't accept stablecoins for its debt.
No. Until, at the moment, no. But then when you look at how Tether operates and the way it gets around a lot of the restrictions that would otherwise apply to having access to the US monetary system through the dealer network and through its relationship with Cantor Fitzgerald, I think that in itself is interesting, especially when you realize, the government doesn't accept stable coins, but let's face it, some of the administration clearly do. So.
Yeah, that's a whole different conversation as well. Also, money market fund issuers on the whole don't accept stablecoin, but if you've seen the chart of the market cap of outstanding tokenized money market funds, you can start to see how this is not going to be a barrier for much longer. Again, Genius will allow a stablecoin issuer to hold tokenized money market funds as reserves, and that's a seconds transaction right there. Again, stablecoin issuer doesn't need to hold the stablecoins. It's not allowed to actually hold the stablecoins waiting for the reserves. It has to simultaneously and on chain, it can in the same transaction even mint the stablecoins by the tokenized money market fund or tokenized treasury when that becomes more of a thing. It has magicked money into existence. It doesn't need a stablecoin purchaser on the other end. I think this is something that we haven't fully appreciated.
So why do you think the assumption until now was that it wouldn't create net new supply? Like where were people going wrong? I mean, now that you've explained it like that and you've done a great job, like it seems self-evident that it does create new supply.
I don't want to spread conspiracy theories, but I think we all know that it's sort of a need to know thing. Stablecoins have a lot of political support, again, for reasons we've discussed. And the more bankers are aware of this potential, the greater, the louder the pushback and the more support they would probably get in Congress. I am bewildered that there hasn't been more pushback on this, I confess. And I'm especially intrigued that this paper was published by a European think tank, not an American one. And I think that's relevant for a point I'll get to in a second, because jurisdictions matter here for reasons, again, reasons we're not fully paying attention to. Two more points, and these 2 points I want to add on the end. They're not in the paper. One is that Genius, I think I sort of hinted this already, does not require stablecoins to be minted against cash. So I could send Circle, to take an example, $100 million of a money market fund I hold. Circle accepts that money market fund and mints me the stablecoins. Now, no deposits have changed hands here, which again is something we're not fully appreciating. And there is 100 million more in the system. Again, we don't even have to go through the whole deposit transfer steps. I could just send them a treasury, a government bond or a money market fund and get stablecoins in return. That's new money. And then the fourth thing is it comes down, and this is before we even look at reverse repo. Stablecoins are allowed to participate in reverse repo, in which they mint stablecoins, put it into the reverse repo, get treasuries and exchanging. That's a whole different lever. But then the fourth thing I want to mention is that this will have particular relevance in the United States because it is the only outstanding stablecoin regime at the moment that allows 100% of reserves to be in treasuries or in money market funds. It doesn't mandate deposits in banks, unlike, say, the European regime. Now, if indeed we understand that stablecoin issuance and the money goes into treasuries or money market funds or other similar asset, that creates new money. If it stays in a bank, it doesn't. Then that highlights or hints at the potential monetary pressure coming in the United States from stablecoin issuance that Europe won't have. Europe will have some, but nothing like the potential pressure in the United States. And then going back to the Miran paper, if indeed stablecoins are now a figure in the monetary aggregates, create more money supply that way, even if it's not necessarily via stablecoins, then that is going to affect monetary policy as well as the outlook for inflation. If we agree that more money supply is inflationary, we can see how the United States is going to have more permanent inflationary pressure because of this shift in payment habits than other jurisdictions.
So I think that's all fascinating, and I can totally accept those arguments. I wonder to what degree the fact that new creation is channeled specifically at the treasury market, though, and thus into sort of compressing yields in some way, and therefore being constrained by the fiscal side, is an indicator of, again, what everyone calls the turn and shift towards fiscal dominance in general, because at that point, the real constraint is how much issuance there is in the market to absorb those new deposits that are created. So if the debt ceiling holds and the US government refuses to create any more, all that you will see is that this money it compresses yields effectively, right? Rather than it creates more net borrowing for the government. And in some way, then I'm just trying to think it through. If it's richer, if you have to pay over the nose for a treasury bill, I think there is an element of is there a sort of sterilization element there? I'm maybe being a bit stupid, but it only really becomes a risk in terms of velocity and inflation if the government chooses to just continue printing continue borrowing. I mean, am I right in thinking like that it just passes a little bit more control to the fiscal side of the economic balance? I don't know. That would be.
I agree with
at this point, money becomes incredibly mysterious and weird
yes.
because it never disappears from the system. So even when even if you're paying over the odds for a treasury, the money still percolates until the central bank itself decides to extinguish it in some ways. But I wonder to what degree also the moneyness and the velocity matters in terms of like the stable coins that are created against that underlying also have to have a velocity effect to really have an inflationary effect, right? So if you're just buying those stable coins as an investment wrapper or something like that, then I don't know if I mean it all comes down to velocity basically.
Which is why I've always thought that the yield debate is just so stupid. I am against banks lying to the public as they have done in their claims about the impact of yield-bearing stablecoins. I'm just in principle against that. But stablecoins shouldn't have yield, in my opinion, because they are created to circulate. I think tokenized money market funds should be made available to the public without the stupid securities regulations that prevent that from happening. It's not as if they're risky. But stablecoins should circulate, and that comes down to your velocity point as well. I'm envisioning a world, and I think Atkins is definitely aware of this and is moving towards it, where we can have idle stablecoin balances, and rather than convert them out and put them in a yield-bearing product, we just sweep them into a tokenized money market fund, sweep them back out again 24/7 within seconds when we need them. Right now, we do need some reform on securities laws, and the SEC is moving towards that. But that's where we're heading, I think. The yield debate is smoke. It's a total distraction, and the banking lobbies have totally missed the boat.
Yeah. Anyway, there are all sorts of secondary effects that I think need thinking through. I think we're only just scratching on the surface, really.
Why, Izabella, and I love focusing on this intersection because, as we've often commented and winding up here because I know you have to go, it's about changing money, not just changing what is money, but changing how money works and how governments can interact with the economies that they are tasked with supporting. It's changing faster than any of us can keep up with, but hopefully you'll join us next week as we struggle through these issues ourselves. Do please subscribe to our newsletters if you aren't already, because that's where we learn by writing. And also any feedback is very welcome. Reach out to us on Substack or on
Or if there's something you want us to look at specifically, do give us, drop us an email. That would be great.
Indeed. So thank you all so much for joining us today. Look forward to seeing you next week. Thank you, Izabella. This was fun. There's just so much to think about.
Very cerebral. But thank you, Noelle. Lovely to see everyone. Take care.
Talk to you all soon. Bye-bye.